Kia ora, and welcome to the CoreLogic Property Market Update for Hongongoi, July 2023. Property values continue to fall in Aotearoa in June. In fact, the rate of decline actually accelerated to 1.2% from a fall of 0.7% in May. The more granular results show diverse conditions across the country, with Tamaki Makaurau, Auckland, leading the weakness in June, falling by 3%. While at the other end of the spectrum and country, Waihopai and Whakago, values increased by 2% over the month. The average value nationwide is now roughly $910,000, which is 10.6% lower than the same time last year, but still 25.1% or $183,000 higher than pre-COVID. This context is important because it's this high average value, a result of very strong growth in 2020 and 2021, now combined with comparatively high interest rates, which is continuing to constrain demand and extending the downturn further than many expected. While aggregate demand is historically weak, it's also up against limited supply, with the flow of properties coming to market persistently low, now leading to falling overall supply, as is typical for this time of the year. This means we are seeing some upwards price pressure for certain properties in a handful of areas, and perhaps the only thing that will be consistent through this phase of the market will be inconsistency. It appears to be just as easy to find examples of properties achieving a strong price as it is to find those which are on the market for a long time and are having to be discounted heavily to sell. At a regional level, this inconsistency is leading to volatile results month to month, so it's important to focus on the trend, which is showing an easing in the downwards momentum of price falls. Over the quarterly measure, both the Tamaki Makaurau, Auckland and Tauranga markets continue to display weakness, while Kirikiriroa, Hamilton, and Te Whanganui Atara, Wellington, price falls have moderated. And the Ōtautahi, Christchurch and Ōtepoti, Dunedin markets are almost flat. Noteworthy urban areas outside the main centres are Tahuna, Queenstown, and the aforementioned Waihopai and Whakago markets, up roughly 1% over the quarter, with Rotorua not far behind, and both Whanganui and Ngamotu, New Plymouth, essentially flat. However, weakness is persisting in Tairāwhiti, Gisborne, Te Papaʻioia, Palmerston North, Whakatu, Nelson and Whangarei. From a high-level demand perspective, availability and cost of credit remains in the spotlight. As originally foreshadowed, the Reserve Bank Monetary Policy Committee followed through with a pause in their latest OCR decision, leaving the rate at 5.5%. Recent data has generally been in line with what the bank will have wanted to see. Inflation has moderated and inflation expectations have also fallen. Additionally, the labour market has loosened a touch, as strong migration has helped alleviate skill shortages across a number of sectors, meaning this decision was very much in line with expectations. For a market yearning for certainty, this will have been welcomed by consumers and businesses alike. And although the banks continue to tweak mortgage interest rates, there are unlikely to be any further dramatic shifts upwards. This will please mortgage holders, especially those with mortgage renewals upcoming, of which there remains a large proportion of the market. The latest Reserve Bank data shows 51% of all loans are due to reprice within the next 12 months. And while we've moved through this wave of adjustments since the middle of 2021 without too many visible signs of pain, it remains an area to keep a close eye on. Indeed, in a new data series from the bank, which focuses on mortgages originated in the past couple of years, we can see that the period to watch could be from September, when sizable amounts of lending will be up for renewal. Some refixing from a 2-year rate in the low 3%, and some rolling off a 1-year rate around 5%. The adjustment could look quite different for each of these profiles. The jump from 5% to today's 2-year rate of 6.5% would cost an extra $1,200 a year for every $100,000 in debt. For anyone moving from 3.25% to 6.5%, that figure more than doubles to almost $2,400. For a $300,000 mortgage, that could mean $275 a fortnight for those coming off the 3.25% rate, adding further pressure to household finances already dealing with high inflation and a cost of living crisis. Further belt-tightening from consumers will flow through to reduced spending in our economy, and the increased likelihood of a double-dip recession later in the year. For now, our strong labour market continues to insulate us from even worse economic performance, as well as expectations of the property market downswing worsening. But it should be acknowledged that downside risks remain. This is likely to be one of the major factors the Reserve Bank has considered when it comes to their forecast for the OCR already being at peak. It's now time to wait and see how things play out after a long and strong rate hiking cycle. To stay across the latest property market data and insights, make sure you follow all our news updates on the CoreLogic NZ social channels, including LinkedIn, Instagram, Twitter or Facebook. Download our latest monthly chart pack and subscribe to our New Zealand Property Market podcast on all good podcast players. Mā te wā.